Hey, this is Warren Redlick. The stonks are down. Tesla's shares are down below $750 a share last I checked, and people are panicking the sky is falling. So, I wanted to respond to some concerns I've heard from people. Gee, Warren, why is the stock down? Before I get into that, I want to thank the Vasa law firm in Sweden and all my Patreon supporters for helping this channel grow. And I also want to remind people about the t-shirts, elonbits.com. There's a link in the description below, both to Patreon and to elonbits.com. You can get t-shirts like the Elon Fan Club t-shirt and so many others. So the first thing, why is the stock down? Well, the stock is down because more people are selling than are buying. That's how markets work. Some people think they can make money by selling the stock, maybe buying it later or just selling the stock. Some people are worried where the price is going. I can tell you for myself, I am not worried about the price. I actually bought stock the other day at $773 a share, I think. But what I wanted to do was talk about the difference between two types of investors. I think that's going to help explain where this is going. Are you ready? Let's go. There's two kinds of investors. This is a massive oversimplification. Of course, there's more than two kinds of investors. But most of what I do here is I come up with models to try to simplify complex things and make them simple. So for right now, I'm going to oversimplify and say there's two kinds of investors. There are long-term investors who are looking out 5, 10 years or longer. That's me. And there are short-term investors who are looking at this quarter, next quarter, maybe the quarter after that. They're not even looking a year ahead. And I'm talking about people like Gary Black. Gary Black is on Twitter, GaryBlack00 on Twitter. He is a self-described professional investor, and he tweets a lot about Tesla, and he's generally pro-Tesla. So this is not about pro-Tesla people versus anti-Tesla people or Tesla Q. This is about people who have short-term outlook versus people who have a long-term outlook. Gary has been generally pro-Tesla, and even now he sets his price target at $960 a share, well over the current stock price. But he sold at 870 something, and he's saying he's going to buy back in again in the mid 700s, which were already there, and he hasn't bought in as far as we know. So he's a little fuzzy on what he means by his price target of 960. This is actually one of the side notes here. People will always ask me what my price target is. I don't have price targets. Price target is a Wall Street term that I don't even understand, because here's a guy who has a price target of 960 and he sold at 873. So what did he mean by his price target? I project where the company is going over the next 2 years, 5 years, 10 years, and where that business model leads to in terms of revenue, profits, and ultimately when you have profits and you know how many shares there are, you know how much a share should be worth. Now, what a share should be worth and what it shows up as a price on the stock market is altered by the fact that there's all these short-term investors out there who aren't thinking long-term. My evaluation is based on what a long-term thinker should think the stock would be worth. And I can't help it that there's all these short-term investors out there who are looking at things that I think are irrelevant. Just to give you the context, if you are buying the stock and you are holding it for 5 or 10 years, and Gary says this in this interview, then hold the stock. You'll be fine. The stock is going to grow. If you are a short-term playing the numbers, going quarter by quarter and looking for chances to buy and sell and make money on dips and all that, then that's not the kind of analysis I'm giving you. And if it bothers you that stocks move up and down, then you probably shouldn't buy stocks at all, but you certainly shouldn't rely on me because I don't care about the ups and downs. I am looking at that long-term 5 to 10 years, and I have seen nothing to affect that long-term thesis. Not one thing. So what I'm going to do now is I'm going to go through some of what Gary said in an interview with the channel Spark Spread, a channel I recommend. Great guy, Matt, who just started this channel, and he's making good progress, and I think you'll enjoy it. He doesn't make as many videos, but he's worth watching. So I'm going to go through what Gary said on that channel, on that interview, and break down why I think he's wrong. This is what he's saying. This is what he means. It makes sense in his context of the short-term investor, but it does not make sense in the context of the long-term investor. And there's a particular moment later in this interview where he finally exposes what he thinks Tesla will be, let's say 2025. And his numbers in 2025 are way off from where I think Tesla's going to be, and way off from what I think you think, if you're following this channel, what you think Tesla's going to be. Let's see what he says.
The balance sheet continues to get better. It could almost be investment grade today. And I look at all those catalysts. I say, look, there's a lot of catalysts that can drive the stock. And so, look, from a long-term perspective, it's a great value. If you're a retail investor and it's the only stock, you should not sell it. You should not do what I do. You should just hold on to it. ride it, and it'll be fine because within 6-9 months it'll probably be back to where it was when I sold it.
I just wanted to start with that. You heard it right there from Gary. If you're a retail investor, a long-term investor, then stick with it. You don't need to sell now. It's going to bounce back to where he sold it. He is saying that in 6 to 9 months, it's going to be back up to $870 some a share or more.
There's a few reasons I would say. One is, again, upside downside. When the stock is, at 800, you can't like it as much as you liked it at 400 or 200. You don't have as much upside. It can't be some people say it's going to have the biggest market cap of any company, but it can't. It can't, keep going at the same rate.
I hear this kind of thinking all the time from people talking about stocks. Well, it can't keep growing like that. Well, this is exactly the opposite of Elon Musk's thinking. You don't say something can't happen. You might have reasons why you think it's unlikely to happen, but you can't say it can't happen. No one thought in 2013 that Amazon was going to 12x. Very few people thought that Apple would reach over $2 trillion. But these things happen. Things that you don't think will happen do happen sometimes. So you have to have an analysis. Well, wait a minute. Why do I think it can't be the largest market cap company? And I'll tell you, I watched the entire interview. He never gave an answer to that question. Matt didn't ask him. I would have asked him the question. I love Matt, but I feel like when I see other interviews, people don't ask the same questions I would ask. And that's a question that should have been asked. Well, why not? This is a classic example of not using the first principles thinking that Elon talks about. Why do you say that it can't grow that much? And his entire analysis is infected by this cloud he has of how he looks at things that ignores the first principles thinking underlying why Tesla is going to be the largest company, why it is growing the way it is, why it is growing much faster, why it will grow much faster than he thinks it will grow over the long term.
They missed the fourth quarter volume number by 350 cars. And as an analyst, again, if you're not if you have excess demand and you're building cars, why couldn't they get those 353 cars out to get above the number? I don't know. Maybe they just lost track.
I love Gary as an analyst. I love his account on Twitter. But you've got to be kidding me. 350 short of 500,000 is not a 1% shortfall. It's not a 1/10 of a percent shortfall. It's a 0.07%. Not 7%, 0.07% shortfall. They missed 500,000 by 0.07%. They had 99.93% of the cars that they were shooting for. They basically made the target. It's not hard to round up and say, okay, they made 500,000. If you are going to say that this is a miss, that this is not enough, that this is a failure, then you've just got to wake up. It's borderline insane to apply that kind of analysis. We had all kinds of headwinds in 2020. They predicted 500,000 in 2019 before COVID hit. In the face of all of these problems, in the face of these massive problems economically around the world, where other car companies fell short by 20%, they dropped sales by 20%. Tesla increased sales by like 30 or 40%. This was a massively great year. Barely missing 500,000 cars delivered by 0.07%, and you think this is a red flag? Gary, you're better than this. It's nonsense. Anybody who didn't think this was 500,000 needs to go back and take some math classes. It's 500,000.
But the 500,000 was full year, that was guidance that was given pre-COVID.
Was the fourth quarter, which the 500 was reiterated at the end of third quarter.
Okay. Gary's just nitpicking here. This is what they said in the quarter 3 slide deck. They have the capacity to produce and deliver 500,000 vehicles. Achieving this goal has become more difficult, but delivering 500,000 vehicles in 2020 remains our target. They're trying to get to 500,000. They're not promising they're going to deliver more than 500,000. They're trying to achieve 500,000 in the face of difficult circumstances. And they said it depends on quarter-over-quarter increases, further improvements in logistics, delivery efficiency. They didn't say we're going to do better than this. They said we're trying to achieve this, and they came as close as you possibly could. 99.93%. Gary's nitpicking. Get over it. This is, even on the short term thinking, this is nitpicking. Long term, this doesn't matter at all. We're going back to this long-term investor versus short-term investor thing. Long-term investors don't care about this at all, but even from a short-term perspective, this is super trivial.
they missed the earnings number by a lot. They came in at 80 cents, adjusted earnings. We use non-GAAP. And the street was at about $1.03, $1.04. I think you and I were both probably $1.05 to $1.10. Some other people were higher, but they missed by a lot. And it was gross margin. And what kind of got my attention was on the conference call, they talked a lot about these are one-time factors. They talked about the SX refresh. They talked about the COVID disruption. The semiconductor short. They talked a little bit about the pricing, and said these are one-time factors. But when you start thinking about a lot of these are not one-time factors. The SX refresh is continuing into the first quarter.
This is another example of both short-term thinking and nitpicking. Okay, they said that the Model S and X refresh was a one-time event. And then Gary says, well, that's continuing into the first quarter. Well, of course it's continuing into the first quarter. That doesn't mean that they're refreshing it twice. It's a one-time event that will carry into the first quarter, yes. Model S and Model X are not important for the long-term value of Tesla. Tesla is going to be a Model 3, Model Y, and 2023 Tesla compact company, plus an energy company. There's a lot going on. Model S and X long-term are trending to be very small parts of Tesla. If you're a short-term investor, you're thinking, well, this is a high-value product, and in the mix of things, this matters, but it doesn't matter for the long term. So it's a short-term thing. And again, it's nitpicking to say this isn't a one-time thing. It's a one-time thing. They refreshed it once. They refreshed it at the end of the fourth quarter, and that carried into the first quarter. This isn't rocket science. This is really straightforward. Is it going to have an impact on short-term numbers? Sure, it'll have a small impact on short-term numbers. It doesn't matter.
And so as I think about, let's just take first quarter and second quarter, I try to model out the quarters. I'm getting about 162, 165 for the first quarter. The street's at 167, but a lot of the Twitter analysts are up at the 180 range. And, there's a bunch of them out there, but I'd say on average about 180. And in the second quarter, same thing. I'm about 10, 15,000 less than where everybody else is. So when I put it together, first half, I'm at 345, 350 in volume.
So Gary is projecting Tesla to sell in the ballpark of 350,000 vehicles in the first half of 2021. Now let's start with this. He's very, very focused on this coming quarter and the next quarter. And you almost don't hear much analysis from him beyond that. He will go out to the full year, sort of. But 350,000 for the first half of the year, and I think you're going to hear him say he's expecting 800,000 for the full year. Well, 800,000 is a 60% gain on 2020. That's 60% growth. 60% growth for a company is insane. That's monster growth. This is great. This is a guy who's pessimistic now on the company stock, and he's saying it's going to grow 60% year on year from 2020 to 2021. Well, if that's your pessimistic scenario, that's pretty good. Even 750,000 vehicles for the year would be a 50% growth rate, which is fantastic. Where are people getting that this is a problem, that it doesn't reach 800,000 vehicles or it doesn't reach 500,000 vehicles? This is a fast-growing company that is innovating like crazy and coming up with great improvements in vehicles and improving our lives. And Gary doesn't get any of that.
Then you got to decide, do you want to get out of the stock because of that? Enter Bitcoin. Okay, so I'm annoyed. I'm not annoyed by it. I mean, if they want to own Bitcoin, they can own Bitcoin. But it's again, as a professional investor, it does introduce huge earnings variability. And what people need to know about Bitcoin, and we can talk about Bitcoin as an investment if you want, but what people got to know is, the professional investor is going to be annoyed by them using 8% of their corporate cash to buy Bitcoin, because the gains you can't recognize unless you sell it, but the losses you have to, basically put an impairment charge in if it goes below what you paid for it.
Hey, there's a little bit to unpack in here. So Gary is talking about this thing where Tesla announced that they had bought $1.5 billion worth of Bitcoin. And for some reason, Wall Street thinks this is a problem. Now, Gary makes a reference to it being 8% of your cash. Okay, well, it's also 0.2% of the company's market cap at the time that this happened. You're valuing a company that's worth $800 billion, $700, $900 billion, whatever, and you're worried about $1.5 billion. Again, you're nitpicking. Now, there's an important detail here that he talks about that shows a really significant contrast between this kind of professional investor who's looking at what I think are the wrong things and the rest of us. That the way accounting works for this Bitcoin investment is if the Bitcoin value goes up and you hold it, you don't get to account for that when you report your earnings. So your earnings don't go up. But if it goes down, you have to report a loss or you have to report an impairment which comes out to reduce your earnings. This has nothing to do with the long-term value of the company. This has to do with the kind of nonsense numbers that Wall Streeters talk about. If Bitcoin goes up, they made basically about $1 billion on this Bitcoin trade so far. The company is practically worth, in reality, Tesla is worth $1 billion more than it was before because of this Bitcoin trade, right? Because they bought $1.5 billion worth of Bitcoin, which is now worth $2.5 billion. And somehow in Wall Street speak, that's a problem because you can't recognize the gain on your balance sheet. And when you report your earnings numbers, analysts are supposed to be better than this. They're supposed to analyze and they're supposed to say, okay, it doesn't show up in earnings, but we know the company's worth an extra $1 billion now because they have an extra $1 billion in assets they didn't have before, right? So that the leaps you have to go through in order to ignore that this added value to the company is crazy. It's just crazy. But that is, again, professional investor, Wall Streeter, this is the way they look at things. Long-term investor, this is the way we look at things. And there's a lot of them out there. There's a lot of Garys out there who apply this kind of crazy analysis. They just grew their assets by $1 billion, and you're looking at that as a negative. That doesn't make sense anywhere but some kind of crazy land called the world of Wall Street analysts.
I don't know what you feel about this, but when Elon, who he's brilliant, he's the most successful entrepreneur of my generation, your generation, but every night he's talking about Dogecoin, he's talking about Bitcoin. And I'm sure that's not his focus, but he should be talking about Cybertruck, and he should be talking about other things that are coming out from Tesla.
That's a nonsense criticism from Gary. Elon was just on Joe Rogan, a podcast with millions of listeners, and Elon was talking about that in that conversation with Joe Rogan. It's nonsense to bring this up. This is the kind of you're choosing facts that aren't really accurate, and you're casting the way you want to cast them. Elon talks about Tesla's products. Elon has been talking about the Model S and X refresh. He's talked about Cybertruck. He's talked about Semi. He's talked about SpaceX. He talks about the business that he runs, and he has some fun sometimes and talks about Dogecoin. He's been a joker for a long time. This is not a big deal.
I'm surprised we didn't see a price cut in Europe, because now they're shipping from both, right? There's some stuff coming in from Fremont. There's also stuff coming in from Shanghai. So it wouldn't surprise me to see some price reductions in the first quarter.
This is a classic example of damned if you do, damned if you don't. When Tesla lowers prices, people say, see, there's no demand. They have to lower prices to meet demand. And then when Tesla doesn't lower prices, apparently they're doing something wrong too. People who are critical of what you're doing in your business can come with any reason. Lower your price, aha. You don't have enough demand. Don't lower your price, aha. You're not selling enough. It's not a genuine criticism. They're pricing the way they're pricing. There's a lot of internal things that are going on in the company. They're using benchmarks. They're using analytics, metrics that we don't see. That's how they end up pricing their vehicles, and things are going to change. Personally, I think Berlin Model Y is coming. And when the Berlin Model Y comes, it's going to cost more initially, and its price is gradually going to come down. And they need to do pricing now to be ready so that the price changes that happen when Berlin Model Y happens aren't a big shock to the market. It's my opinion, and I could be wrong. But we don't know. I'm just saying that's what I think might be happening. We don't know what's going on in the heads of the people running Tesla when they're making their pricing decisions. And you can nitpick either way all you want. It's not really a genuine criticism.
The question is going to then be, will that cause buyers to wait and say, well, I'm not going to, they'll walk into a Tesla dealership and say, hey, I want that EV credit. And they say, well, it's not been passed yet. And who knows? By the end of the year, they'll get it. So from a full year standpoint, it's fine, but it could cause first and second quarter volumes to be, delayed a little bit further.
What he's talking about here, and this is particularly unusual probably for non-American viewers. If you're watching this and you're not in the US, you may not know about this. There's proposals in Washington, D.C. to increase tax credits for green products, particularly electric vehicles, but actually bigger for energy, for like It's going to have a bigger impact on Tesla's Solar Roof, on Tesla's grid storage products, Powerwall, Megapack, etc. I made a video about this. You can check it out on my channel. We don't really know what's going to happen with this EV tax credit. And he's expressed concern, which is a legitimate concern, that some buyers will wait on buying a car because they want to wait until the tax credit is available. But this is only a US buyer problem. So Tesla can react to this. If Tesla sees that demand is low in the United States, they can export vehicles from the United States and send them to other places while demand is lower in the United States. And there's actually a really big benefit if it's delayed. And I'll tell you what that is. I think people don't get this. The proposal that's pending in Congress right now, the so-called Green Act of 2021, you get this window of, right now the proposal is another 400,000 cars. And after that window is over, you get another 2 quarters of sales. The longer it takes to get the EV credit, the bigger those 2 quarters will be. So it's actually in Tesla's best interest if the EV tax credit is delayed, because they will get more benefit from the tax credit if it is instituted later. Because Tesla's production is increasing. So if the 2 quarters at the end will be bigger quarters of production and bigger quarters of sales if it gets pushed out. So it's good news, not bad news. And frankly, I just think Gary hasn't thought that through. The Wall Street analysts who are concerned about this, they haven't thought that through. They haven't thought through, A, Tesla can move cars from the US to other countries when US demand is low while people are waiting for this. And B, it's better for it to be delayed because those last 2 quarters are going to be bigger for Tesla. They don't get it. They haven't thought it through.
On top of everything else we have. If they could get the made in China Y up quicker, I think that would be good. And if they could get the S and X out quicker, that would be good.
Did you hear that? That was the sound of short-term thinking. Quicker is not better. It's much more important that Tesla do what it's doing better, that it gets more efficient in manufacturing, that it delivers better quality products. Over the long term, that's what matters. Getting something out quicker is not key for long-term investors. It only matters for short-term investors.
You can see what I tweet. I try to be balanced. I've always tried to be balanced. Even when I remember back in Battery Day, I told people there's nothing new here, even though a lot of people said, come on, there's so much new. You don't understand it, blah, blah, blah.
Yes, Gary, I'm in that camp. You don't understand it. And I've tweeted, just to be clear, I've tweeted to Gary to try to get him to respond to talk about some of the things that Battery Day forecast, like 100 gigawatt hours in 2022 and 3 terawatt hours in 2030. And Gary, whatever reason, I think this is pretty common, he doesn't respond to my tweets. Battery Day revealed a lot of new information. And this is one of those things people say, oh, Elon's not transparent, Tesla's not transparent. Nobody's more transparent than when you look at Autonomy Day and Battery Day and you look what Tesla shows what they're doing. On Battery Day, we learned that Tesla has a plan that they are implementing that is going to dramatically reduce the cost of battery cells and dramatically improve their energy density, they're going to be better battery cells and they're going to cost less. And it's not a small change, it's a big change. And they're going to be able to scale production. The cost of building the factories that make the batteries is going to come down. There's a huge amount of information here. And that was reaffirmed in the Q4 investor call when Drew Baglino and Elon said they're actually doing better. Their progress in the battery cell lines is actually going faster. And I just did a video where I talked about, I had a conversation with an insider who said that battery production is like 30% ahead of schedule. And Texas Model Y production is 30% ahead of schedule. But to say that this is one of those key moments for Gary Black to say that there was nothing new on Battery Day is completely opposite of what anybody else who's paying attention to this and understands it sees. Check out the Limiting Factors channel. He's been doing a series of videos about what he learned from Battery Day. Great channel, great videos. There's a lot there. But plain and simple, for most companies in the world, battery cells have relatively low energy density and cost like $120 per kilowatt hour or more. And Tesla, within a couple years, will have battery cells that are much better batteries. They're going to cost half as much per kilowatt hour. And that is a huge, huge competitive advantage that will help Tesla sell a lot more cars. And structural battery pack, the concept of structural battery pack. He says Elon should be talking about the cars. He just had a conversation with Sandy Munro where he went in depth into why structural battery pack and single piece castings make such a big difference. And Gary doesn't understand that stuff, so he thinks Elon's not talking about the cars. What are you paying attention to? How did you miss the Sandy Munro interview? If you're interested in the substance of what Tesla's doing and you're interested in what Elon's talking about, he goes in depth on this stuff. How did you miss that?
Berlin is getting pushed back for whatever reason. Maybe Austin's going to take longer to get up and running. Who knows?
Well, first of all, so far, the allegation that there are delays in Berlin is an unsubstantiated rumor. There was a rumor about it around February 8th. There was no news following it. There's no support for it. It was just a rumor. Second of all, there's no hint at all that Austin is delayed. My information is that Austin is moving ahead faster than expected. So where he's getting this from, Cybertruck might have a slight delay, but maybe Model 3 is moving ahead and Model Y is definitely ahead. And the battery cell lines are ahead. So who knows where he's coming from? But you just pick a couple rumors here and there, or not even a rumor. I haven't even heard a rumor of Austin being delayed. And somehow he concocts that into a problem. This is not genuine analysis. Don't call yourself an analyst unless you're going to use genuine analysis.
And I don't want to say that, there's a demand problem. People have misconstrued some of my comments. I don't think there's a demand problem. But I think, in 2021, I can't see them doing more than about, 800 is kind of my top number. And, it's somewhere between 760 and 800, still 60% growth. Yeah. But again, the street's at 815. I would wager, a lot of money, they're not going to hit 1 million deliveries for this year just because they think they can produce 1 million maybe. It's hard if I'm only getting, let's call it 350 in the first and second quarter, that would mean 650 to get to 1 million. Now, if they do 1 million, somebody estimated this the other day, what would be your price target? Just assume they hit 1 million for this year. And my price target would probably be 1,500 if I was 100% convinced they could do it, but I don't think they're going to get that high.
Gary doesn't want to say there's a demand problem, but he doesn't think there's enough demand to buy the cars that Tesla might be able to produce. Well, that is a demand problem, so you are saying there's a demand problem. So make up your mind what you're saying. Either you think there is enough demand for people to buy 1 million Tesla vehicles, or you think there isn't enough demand. Make up your mind. I think there's certainly an open question whether they'll be able to produce 1 million vehicles, and maybe they'll only be able to produce 800,000 vehicles, but they will sell essentially every car that they can make. And I don't think Gary believes that. So when he says there's no demand problem, it's obvious he believes there's a demand problem. And he's wrong. You can disagree with that. If you believe that Gary's right and there isn't sufficient demand for Tesla vehicles, okay. Everything I've seen, Tesla is supply constrained. They're battery constrained, which keeps them from making enough vehicles, and they're supply constrained otherwise, and that makes it hard for them to make enough vehicles to satisfy the effectively unlimited demand that is out there. The demand is effectively unlimited as long as they can make more cars and they can make them affordable, which is a challenge, making more cars and making them affordable. That's what they're working on. That's the goal. That's why you got to get battery costs down, why you need structural battery pack, why you got to get more efficient, all of those things. The demand is effectively unlimited.
You could add solar, but they don't make money in solar, and it's very small. It's rounding error, right? The money is in the automotive business.
Now, I half agree with Gary on this. Solar alone is not going to generate a huge amount of revenue. If you do 1 million roofs a year and it costs $30,000 a roof on average, it ends up being not that much money. It's $30 billion a year, but compared to where auto is going, it's not that big of a deal. But Tesla Energy as a whole, when you include Megapack, when you include Powerwalls, and you figure out the amount of batteries they're planning to produce that will go into these products, I'm working on a model on this right now, and the numbers are huge. It may actually be bigger, both in revenue and profit, than auto, leaving Robotaxi out. Once you throw Robotaxi in, I think Robotaxi takes over. But Tesla Energy, they said at Battery Day, and I'm starting to look at my analysis again, the revenue and the profit from Tesla Energy will be comparable to and possibly bigger than Tesla vehicles. And Gary doesn't see it. He doesn't really talk about energy at all. I don't think he's aware. It's almost as if he's unaware that Powerwall and Megapack exist.
But Robotaxi is a big factor, and you either add value for that or not. I build that into my model. So when I try to forecast earnings for 2021, 2, 3, 4, 5, I assume a take rate, as you do, I think. Yep. And then I try to assume, what that translates to at the bottom line. It all drops to the bottom line. So you can do it that way, or you can take that out of your model and you can say, okay, what is FSD worth? And if you could charge some sort of revenue and Tesla gets a cut of it, there's a value to that as well. You can do that, but you can't do both, right? Mm-hmm. Unless they're going to get into a whole new business. They're going to compete with Uber and Lyft, and they're going to have, a business where it's the Tesla network and it's totally independent of that. Okay. So they have their own cars.
First of all, I agree with Gary. You can't count things twice. You can't count FSD revenue and then count robotaxi revenue as if Tesla owned the vehicle. You can count FSD revenue and count some share of the robotaxi revenue if Tesla runs the model they've talked about, where Tesla maybe gets 30% of the revenue your vehicle generates while it's driving. And he seems to be unaware of that. And even more so, he's unaware that Elon has been talking about, and Tesla talked about it in the fourth quarter slide deck, that they are planning to start an autonomous network that would compete with Uber and Lyft. How do you not know that? How do you not know that it is part of the plan that Elon said at Autonomy Day that they expected to have a fleet of 10 million of their own vehicles? That in the quarter four slide deck, they said, we are going to start an autonomous ride-sharing network. It is the plan, Gary. It is the plan. It's going to happen.
But then you got to ask yourself, okay, you've got a lot of people who are trying to come up with this self-driving car. Let's call it L4 autonomy at a minimum. I'm not smart enough to know if Tesla's going to get there first, or Uber's going to get there first, or Amazon's going to get there first, or Baidu's going to get there first. I don't know. But let's assume Tesla gets there first, okay? And I can guarantee you Tesla knows how to scale it. Whereas, these other guys, they might be able to get there at the same time, but it's going to cost an astronomical amount because they can't scale it. I just don't know if you can put, at this point in 2020, what this is going to be worth when it gets there, when you got everybody trying to get to that holy grail.
So first of all, Gary kind of gets it, but he doesn't really get it. They can't scale. Well, they could scale, but what he doesn't see, and what it seems like a lot of people don't see, is, first of all, Tesla's going to get there first. But the other issue is just the cost per mile, that when Uber or somebody else has a plan for a full self-driving vehicle, their system typically costs ballpark of $150,000. And the vehicle is going to last about 150,000 miles. So the cost per mile starts at $1 a mile or more, the way you depreciate the vehicle. And then you've got other costs like fuel or electricity or however you're doing it. Tesla's robo-taxis are going to cost in the ballpark of 10 cents a mile or 5 cents a mile or maybe even less. So there's no cost competition. Even if the other company could scale, and they're going to put this bulky vehicle with a LiDAR unit on it that sucks battery, and it's going to cost $150,000, it's going to last 150,000 miles. That's not competitive with a $25,000 2023 Tesla Compact that's going to last 1 million miles, because the 1 million mile Compact is going to cost 2.5 cents a mile, 0.025 American dollars a mile versus $1 a mile, and that's just the depreciation. And the robotaxi, the Tesla robotaxi, is going to be more efficient. It's going to use less energy. It's going to require less maintenance. Huge advantages that very few people get. Now, Gary's point that we don't know enough yet to model it, well, that's not really true. And if you look at my models, what I do is I say, okay, here's where I think Tesla's going to be without FSD. And then in this column, here's where Tesla's going to be if we include FSD in this way. And you can look from this column to this column, and you can say, well, what's the probability they're going to get to where Warren thinks they're going to get? If I'm really optimistic, then it's all the way over in the column with all FSD. If it's never going to happen, you're in this column, which is still a great column, by the way, but you're probably somewhere in the middle there. And that's what I do in my models. Gary just says, well, poof, I can't model it. But that's not sensible. We know they're working towards it. We know they're making progress. Sure, we know other companies are making progress too, maybe. But it's likely to happen. Pretty much anybody who looks at self-driving is going to say it's going to happen within the next 5 years. Anybody who knows what self-driving is all about. I think it's quicker. I think it's a year or two. It doesn't matter if you're looking out 5-10 years anyway. If it's going to happen within 5 years and you're looking 5-10 years out, then what matters is that you can produce it to scale, like Gary says, and you can do it at a low cost per mile. And that's where Tesla's heading, and no one else is heading anywhere close to there. You have to model that. You have to throw it in if you're going to do a genuine model. If you're going to be an analyst, you got to do analysis, you got to analyze. And you can't just throw it out because you're not comfortable with it. You got to come up with something, and Gary won't.
So as I get to 2025, and again, ignoring the robotaxi, assuming I get 25% EV adoption and roughly 25% EV share times a global SAR of about 80 million, which isn't really that much because it's right now it's about 72. You get when you multiply it out, I have ASP, average selling price, going down because they're launching the M2. Cybertruck will bring it up, and obviously Semi will bring it up.
In the interview, Gary never completed the math. He said EVs would have a 25% share of the vehicle market in 2025, and Tesla would have about a 25% share of that. And it would be an 80 million vehicle market. So 25% of 80 million is 20 million, and 25% of 20 million is 5 million. So he's predicting essentially that Tesla will sell 5 million vehicles in 2025. This is where he's trapped in this EV market share type of analysis. As Elon has said, and as I've been saying, the battery revenue model explains it much better, and Gary can't get his head around the battery revenue model. You would have to ask yourself the question, well, how many batteries, how many gigawatt hours of batteries will Tesla make in 2025, and how many gigawatt hours of batteries will they buy from suppliers in 2025, and what will they do with those batteries? And Gary is completely ignoring energy revenue. If you look at how he's talking about this, there's still no energy revenue. There's still no energy profits in 2025 in Gary's model. Well, what happens to all the batteries, Gary? Because they're going to make 100 gigawatt hours of batteries in 2022. They're going to make 150, 200 gigawatt hours of batteries in 2023. It's going to grow. And when you get out to 2025, the number of batteries that they make is very large. And they're buying more batteries from CATL, from Panasonic, and LG Chem. And at 2025, you're starting to get up over 500, 600, 800 total gigawatt hours. I don't think you're to a terawatt hour yet in 2025, but you're getting close to a terawatt hour of batteries. And then you have to ask the question, okay, you've got 1 terawatt hours, or let's say 800 gigawatt hours of batteries to work with. What do you do with all those batteries? If you assume that the average vehicle uses a 50 kilowatt hour pack, then 20 vehicles is a megawatt hour, and 20,000 vehicles is a gigawatt hour. If you go to a terawatt hour, it's 20 million vehicles. I'm not saying they're going to produce 20 or 16 million vehicles in 2025, but half of it would be 8 million, not 5 million. And you'd have the other batteries going into energy products generating revenue and profits. And maybe it's 10 million vehicles and a little less on the energy side at that point, but it's a lot more than 5 million vehicles, and there's a lot more going on than just the vehicles that you sell. And Gary's ignoring all of that, and that allows him to get to a set of analysis that leaves Tesla not making nearly as much money, not generating nearly as much revenue, not making nearly as much profits, as will happen if they succeed in producing and acquiring the batteries that they've talked about. That's a huge miss on Gary's part. He's stuck in his EV market share analysis and Tesla's a car company analysis, and he can't get his head around energy and batteries and all that it matters. A lot of other people get it. Gary doesn't. The Wall Street analysts don't get it because they don't want to. But if you're looking out to 2025 and they've told you we're going to make a ridiculous amount of batteries as we go out from 2022 to 2030, you got to think, what are they going to do with all those batteries? And you could say, you know what? I think they're full of it. I don't think they're going to make all those batteries. But you would have to confront that analysis, and you'd have to say why you think they're not going to make that many batteries, right? And you have to say they're not going to use that many batteries. You have to confront that. And he hasn't confronted that, and a lot of people who are down on Tesla haven't confronted that. The long-term future, going out to 2025, going out to 2030, even in 2022, is much brighter than they realize. As soon as the battery constraint is removed or minimized, as the battery constraint is reduced, the growth grows fast, the revenue grows fast, and the profit goes fast, and that means the stock grows fast.
You know, when I put it all together, and I have a healthy increase for SG&A, you know, I'm getting $29 a share in earnings by 2025. And then you have to figure out what multiple will the market put on. Today, the market's putting a multiple on next year's earnings at 200. But as I get up to 2025, and this is where the robo-taxi discussion becomes important, the market's going to say, okay, for the growth rate I have from 2025 on, what multiple should it be? And I'm just putting a 2 times peg on it because I'm only coming up with about 25% growth from 2025 on. So I put a 50 multiple on it, and I think that's conservative. Times $29, that's $14.50 discounted back. That's worth about $9.60, and interest rates have gone up, and that's why a lot of growth stocks have gotten, not just Tesla. I mean, a lot of growth stocks have gotten hurt as rates have gone up.
So there you hear, on top of the disregard for Tesla energy, on top of the ignorance of how many batteries there are and what they can produce, he now says going out from 2025, he sees growth slowing. So if you work through his numbers and you figure 5 million vehicles, by my math, he gets to about 250 gigawatt. His 5 million vehicles translates to about 250 total gigawatt hours in 2025, where I think we're going to be looking at 800 gigawatt hours or more. So really, you look at his numbers from my perspective, if you believe the Battery Day story about producing a lot of batteries and rapidly growing the amount of batteries, you're going to talk about tripling his numbers for 2025. Plus, you've got the growth problem. Is if he gets to 250 gigawatt hours in 2025, and that's the batteries produced by Tesla and the batteries that they buy from suppliers, you only get to 250 gigawatt hours, which I think could happen in 2022. But if you reduce the growth rate from that point, you never come close to the 3 terawatt hours that they talked about at Battery Day. So Gary should, if he's going to be serious, answer this question. If you think Battery Day had no new information, why are you saying they're only going to have 250 gigawatt hours of total battery usage produced and bought from suppliers in 2025? That's a radically different number from what they said at Battery Day. And that is what Gary is getting wrong. That is the fundamental error, is he's trapped in his other model about EV market share, and he's ignoring energy, and he's ignoring the battery production, and that's the only way you can get to where he is. And he still gets to Tesla being worth $960 today. $960 a share. If you went to Gary and if you got Gary to follow the battery revenue model, he would have to triple his numbers for 2025, and he would have to triple his number for 2021. And he would have to acknowledge that Tesla stock today is worth $3,000 a share.
So I'm coming up with about 960. To me, at 800, or where we finished today, 787, it's a great value.
Mm-hmm.
So I'm not opposed to people just holding on. And look, if I didn't think the way I did, where there's lots of opportunities out there, I probably would have held on to it. But I'm just looking at it and saying, okay, 2025, it's worth a lot of money, probably 1450, discounted back worth 960. It's worth holding on, and I have no issues whatsoever with it being one of the best plays out there today, best investments out there today.
Yeah.
I want to thank Gary for patting us poor little retail investors on the head and telling us that's okay, little boy. It'll be fine. You can hold on to your Tesla stock. It's a good play. The harsh reality is that Gary, this is it. You guys have seen my models before if you watch my videos before. You've heard what Gary's take on it is. You either believe in the battery story or you don't. If you believe in the battery story, if you believe they're going to make 100 gigawatt hours in 2022, if you believe they're going to expand that to 3 terawatt hours in 2030, then Gary's wrong. He's just wrong. And Gary won't come to grips with it, but you have the opportunity to interpolate. You can look at what Gary says, short-term investor, Wall Street analyst, doesn't consider Tesla energy, doesn't consider batteries, just uses some kind of model that's out of date and doesn't really fit Tesla. Or you can use long-term investor thinking and consider the whole company. That's why I think Tesla remains a tremendous investment, worth way more than his $960 a share. I actually think it's worth more than $3,000 a share today, because he got to his 960 number by using a lower price earnings ratio because he reduced growth going out from 2025. You get to 2025 and you still think you're going to hit 3 terawatt hours in 2030, you still have 50% growth, and you have to use a higher price earnings ratio. And it's even above the $3,000 number today. I know for some of you, this is a tough time because you've seen Tesla stock go down. When I started this video, it was $740 a share. Now it's $710 a share last time I looked. I know that's frustrating. But the practical reality is, if you're a long-term investor, these are bumps in the road and you don't need to worry about it. If you're trading day to day, then I'm not the person you should be listening to. If you're looking long-term, I think I'm a person you should be listening to. And Gary is clearly not a long-term 10-year thinker. The best he can do is 5 years out. Nowhere in here does he go beyond 5 years out with any analysis, doesn't consider the whole company. I hope this is helpful. I hope this is reassuring. If it's not reassuring, if you can't play this game, if you can't live the long-term investor game of accepting that there's going to be bumps in the road, then you need to talk to a professional investment advisor and consider doing something else with your money. If you are willing to ride the long-term investor game and you believe the story that they're telling from Tesla, and Gary doesn't really say it's not true, he just doesn't address it. If you believe their story at all, even if you believe half their story, the stock is worth way more than what Gary is saying and what the market is saying today. If you like this video, please check out some of my other videos. Please support this channel on Patreon. Check out the t-shirts at elonbits.com. Links in the description below. Stay strong, and thank you so much for watching.